Friends, today let us observe how to calculate the changes in working capital. When we say change, comparison is the key. Without comparing the original with some other things, it is not possible to identify the change. For example, you are asked to go to market and purchase 1 kilo of tomato. Fine, you purchased and paid rupees 20 per kilo. After returning home, mother says, "Oh, the price of tomato is rising." How she come to know? Last week she went to purchase tomato and she paid rupees 15 per kilo. So definitely she is the right person to say that the prices of tomato in this week is rise by rupees 5. Like that. Whether the working capital during a particular accounting year is increased or decreased can be identified only by comparing the working capital of the current year with the working capital of the last year. The working capital, as we know, excess of current assets over current liabilities, or current assets minus current liabilities is equal to working capital. The difference between the closing working capital and the opening working capital in the beginning of the year is net working capital. It indicates whether the working capital is increased or decreased during the accounting year. So, look at this problem to understand this concept of working capital flow or change. See, this is the problem, or the balance sheet of a particular business. The left hand side shows the liabilities, both long-term liabilities and short-term liabilities. Right hand side, assets, both fixed assets as well as current assets or short-term assets. You have to identify the current assets here and current liabilities here. The assets which can be converted into cash in short span of time, generally 1 year, is called as current assets. As these assets cannot be converted into cash in short span of time, they are fixed assets. Likewise, liabilities. These are all long-term liabilities. You need not require to repay them in a short span of time. The capital is there as long as business is continue. Debentures you need not require to repay in a short span of time. Reserve you can keep according to your convenience. The profit of the business that you can retain for a long period. But these liabilities, say creditors, you are required to repay the amount to the creditors in short span of time. Bills payable, you are required to repay them immediately after its maturity. So current liabilities are those liabilities which the business is required to repay them in a short span of time, say 1 year. Current assets minus current liability is equal to working capital. How the variations in current assets and current liabilities going to affect the working capital? The 4 important points must have to be kept in mind while calculating the effect of current assets and current liabilities on the working capital. Increase in working capital, increase in current assets increases the working capital. Decrease in current assets decreases the working capital. The liabilities, current liabilities, having opposite effect. Increase in current liabilities decreases the working capital. Decrease in current liabilities increases the working capital. Apply the same logic. So for this purpose we can prepare a statement called as statement of changes in working capital. It contains, for the convenience, 4 columns, 4 plus 1, 5 column. The first column reveals the details of current assets and current liabilities. 2019, the closing balance of the last year becomes the opening current assets and liabilities of the current year. 2020 is the current year, the current assets and current liabilities of 2020. Cash 60,000, 80,000. Increase in current asset increases the working capital. Bank 20,000, 8,000. Decrease in current assets decreases the working capital. It is in decrease column. Debtors 80,000, 1,20,000. Increase in current liability increases the working capital. Bills receivable 40,000, 35,000. Decrease in current assets decreases the working capital. Current liabilities has opposite effect. Bills payable 15,000, 25,000. Increase in current liability decreases the working capital. Creditors 70,000, 60,000. Decrease in current liability increases the working capital. Now look at the total increase during the year, total decrease during the year. Increase in working capital by 70,000 during the year. Decrease in working capital is 27,000 during the year. The net effect is working capital is increase. Increase is more than decrease. Net effect is 43,000 increase in working capital during the year. Net increase in working capital. So you can find out the net increase or decrease in working capital in one more method. Look at this statement of changes in working capital. Changes in working capital. Working capital is the difference between current assets and current liabilities. Current asset at the end, current asset in the beginning, current liabilities at the end, current liabilities in the beginning, working capital at the end, working capital in the beginning, because current asset minus current liability is equal to working capital. The total current assets during the previous year, 2 lakh. Total current liabilities during the previous year, 85,000. 2 lakh minus 85,000 is equal to 1,15,000. Working capital in the beginning. At the end of last year, previous year, nothing but in the beginning of the current year. Total current assets at the end of this year, current year, 2,43,000. Total current liabilities, 85,000. 2,43,000 minus 85,000, 1,58,000. Closing working capital is more than the opening working capital. So closing working capital is increased by 43,000 during the year 2020. Nothing but increase, net increase in working capital. So that is how we have to analyze the balance sheet, how the net working capital is changed positively or adversely during the year. Friends, the COVID is growing day by day. Take care of yourself. It is our responsibility to take care of the members of the family. Wear mask, keep social distancing. Don't go out of the house whenever is possible. If possible, try to give helping hand to those who are suffering from different problems around us. Thank you. Thank you very much.